Hello and welcome. I'm Amy.
And I'm Tom.
We're going to try and make sense of this whirlwind of global economic news today.
It really feels like the ground is shifting constantly, doesn't it? Hard to keep track sometimes.
Absolutely. So, our goal today is really to cut through some of that noise. We've got a market report here,
Hmm.
and we want to pull out the really important bits, focus on how markets reacted to these new trade developments and, some pretty eye-catching corporate headlines.
That's right. We'll try to distill all this complex info into something clear, maybe even actionable for you. This report, it really asks, is trade uncertainty the new normal?
That's the big question.
Yeah. We'll guide you through the key takeaways from our sources, show some maybe surprising connections between things that look separate at first glance. Should be interesting.
Okay, let's jump straight in then. Looking back at Monday, July 7th, 2025, it uh it started okay, but things went south pretty fast.
They did.
We saw a broad decline across the US stock indices. S&P 500 down almost a percent, 0.94%.
Yep.
Nasdaq 100 dropped 0.79%. And the Dow, well, it shed 422 points, also down 0.94%.
A significant drop across the board.
Yeah, I mean, 9 of the 11 S&P 500 sectors ended in the red. So what was the main thing driving this sudden turnaround?
Well, the big driver, pretty clearly, was the White House announcing new reciprocal tariffs. That just reignited all those global trade tensions almost immediately.
Right.
And what's interesting is those tariffs were actually set to be reimposed just 2 days later, on Wednesday. But then that deadline got pushed back to August 1st.
So a slight delay, but the announcement itself spooked the market.
Exactly. It gave a little breathing room, perhaps, but the initial shock was already there.
And the impact was pretty sharp, wasn't it? Losses really picked up speed right after the U.S. announced the 25% tariffs on goods from Japan and South Korea.
Mm-hmm. And it wasn't just them.
No, notifications went out to, what, a dozen other countries? Laos, Serbia. Quite a range.
And those letters even showed up on President Trump's Truth Social platform. Very public.
Which really begs the question, like you said earlier, why such a sharp reversal?
Yeah, especially because markets had just hit record highs the week before, leading into the holiday, and the signing of that one big, beautiful bill.
It really shows how sensitive markets are to trade policy shifts, doesn't it? Especially unexpected ones.
Absolutely. It's like everyone was holding their breath, and then this news just let all the air out.
So moving from the big picture to specific companies, let's talk corporate news that moved the needle. First one that caught my eye was CoreWeave. Huge deal. $9 billion acquisition of Core Scientific.
Yeah, that's a massive deal.
It just screams AI infrastructure, right? What's the strategic thinking there?
Oh, it's absolutely strategic. It's all about getting direct control over the physical infrastructure, the actual data centers. That's becoming so crucial for AI development.
Owning versus renting.
Exactly. If you're in the AI race, owning your compute capacity gives you a huge edge. It's like owning the pipelines when everyone needs water. Really fundamental.
Okay. Then there was Apple. Back in the regulatory spotlight, they're appealing that big 500 million EU fine.
Right. They called it unprecedented.
And they're arguing that EU's changes to the App Store are unlawful. Seems like this tug of war with regulators just keeps going.
It says this fine, it's not just about the money. It's a signal from the EU that their digital market rules have real teeth now.
Could force changes beyond Europe.
Potentially, yes. It could reshape how these tech giants operate globally. It's kind of a new phase in tech regulation. They're pushing back harder now.
But the real standout corporate story, the one really making waves, was Tesla. Shares down almost 7%, 6.79% on Monday.
A very steep drop.
And why? What was the trigger?
Well, the trigger was Elon Musk announcing he'd form a new political party.
Ah.
And investors, it seems, got quite nervous. They're likely worried this could expose Tesla to, greater political risks, a whole new layer of uncertainty for shareholders.
Which seems like a direct contradiction to what he told shareholders back in April, right? About spending more time on Tesla.
Exactly. He'd promised shareholders he'd be allocating far more of my time to Tesla, especially with EV sales slumping.
And the market cap reflects that concern.
It seems so. The Financial Times pointed out Tesla's market cap has dropped over $200 billion since Musk left the Trump administration. It was around $940 billion on Monday, way down from its peak, over $1.5 trillion back in mid-December.
Wow. It's a real-time case study on CEO actions impacting shareholder value.
Definitely, especially when those actions move into the political arena.
So, talking about the sectors then, within the S&P 500, utilities actually did okay, didn't they?
Yeah, they bucked the trend, up 0.17%. Companies like Constellation Energy, Public Service Enterprise Group, Nextera, They saw gains.
Shows that defensive quality, I suppose. When things get choppy, people look for stability.
Right. And on the flip side, consumer discretionary was the worst performer, down 1.26%.
Mostly Tesla dragging it down.
Largely Tesla, yeah. But also companies like Lululemon, they were down over 4%. Mohawk Industries down over 3%. So it wasn't just Tesla.
And the mega caps.
Kind of a mixed bag, generally. You saw some standouts, though, like Palantir and IT, up over 3.5%. But then First Solar got hit hard, down over 4.3%.
So even on a down day, there are winners and losers within the sectors.
Always. Driven by very company-specific things sometimes.
Okay, let's shift gears now. Commodities. Gold ended the day up, but only slightly right, 0.09%.
Yeah, up just a touch to $3,336.05 an ounce. It actually paired some earlier losses.
And that rebound linked to the tariff news. Japan, South Korea.
Seems likely. A bit of that classic safe haven appeal kicking in when trade tensions flare up. Gold's the old reliable in shaky times.
Makes sense.
And another interesting gold detail, the People's Bank of China kept buying gold in June. That's the 8th month in a row they've boosted their reserves.
So central banks are still accumulating.
Suggests a longer-term strategic view. But countering that a bit, the U.S. dollar got stronger on Monday.
Right, which makes gold more expensive for non-dollar buyers.
Exactly. So you have this push-pull effect. Central bank buying supportive, strong dollar a headwind.
What about oil? Prices went up.
They did. Both WTI and Brent climbed over 1%. WTI ended at $67.59, Brent at $69.56.
And that was despite worries about OPEC plus increasing output in August and the new tariffs.
Yeah, it seems robust demand signals were strong enough to outweigh those concerns, at least for the day. Demand seems to be the key driver right now.
Interesting.
And it connects to broader geopolitics, too. Look at Saudi Arabia. They're confident enough to raise their August prices for Asian markets to a 4-month high.
So they see demand holding up?
Seems that way. But you still have those persistent geopolitical risks bubbling under the surface. Yemen's Houthi rebels announced a ship they targeted had sunk in the Red Sea, their first known attack this year, apparently.
More disruption potential there.
And at the same time, you had high-level diplomacy. Israeli PM Netanyahu meeting the U.S. president, and indirect talks happening between Israel and Hamas over a Gaza ceasefire and hostages.
All these things feed into the global risk picture, and oil prices react.
Exactly. Everything's connected.
Okay, turning to currencies then. You mentioned the dollar strengthened.
Yes, it gained against most major currencies on Monday. The biggest move is against the Japanese yen, dollar up 1.00%. to settle at 146.00 yen.
Also gained against the Swiss franc.
Yep, up 0.38% to 0.7980. And the overall dollar index, the DXY, climbed 0.40% to 97.38. That was a one-week high.
Extending gains from last week.
It did. That was largely thanks to strong U.S. labor market data, which kind of dampened hopes for quick Fed rate cuts, makes the dollar look relatively attractive. The U.S. economy is holding up.
But the dollar index is still down quite a bit year to date, isn't it?
Oh, absolutely. It's still near a 3.5-year low, down about 10.7% so far this year. So context is important.
And the euro.
The euro slipped, down 0.59% to 1.1708. There seems to be some growing nervousness about whether Brussels can actually finalize deals with Washington before that tariff deadline hits.
And maybe some internal disagreement in the EU on how fast to move.
Our sources suggest that might be playing a role, too. It just highlights that complex dance between economic data, central bank expectations, and these trade negotiations.
Let's talk fixed income then. Bond yields moved up.
They did. U.S. 10-year Treasury yields climbed 3.4 basis points to 4.385%.
And that was a direct reaction to the tariff news.
Seems to be the main driver,
Yeah.
pushing yields higher. And remember, this is happening just as the Treasury is prepping to sell a lot of new debt this week, $119 billion in coupon-bearing supply.
Right, so more supply hitting the market too. A bit of a double whammy for yields, pushing them up.
Pretty much. And we're also waiting for more policy clues this week. The Fed's minutes from their June meeting are out on Wednesday.
And market expectations for rate cuts are shifting, right?
Definitely shifting. The chance of a rate cut in July, it's almost vanished, down to just 4.7% probability now, compared to over 20% last week.
Wow. So September is the new focus.
Seems that way.
Mhm.
The market sees a September cut as the most likely scenario now, about a 66% chance. And overall, traders are pricing in about 50 basis points of cuts by the end of the year. It's down quite a bit from the 66 basis points they expected just last week.
So the market's scaling back its bets on how much the Fed will cut and how soon. Maybe because of that strong jobs data.
That seems to be a big part of it, signaling a more cautious Fed, perhaps.
There was also a small hiccup with Treasury auctions on Monday.
Yeah, just a brief delay for the 13 and 26-week bill auctions
Yeah.
due to some technical difficulties. A minor thing, really.
And across the pond in Europe. Yields up there, too.
Yep, Eurozone bond yields climbed as well. Germany's 10-year bond yield rose 3.8 basis points to 2.645%. Again, market attention was really focused on those U.S. tariff developments.
But some better news on the Eurozone economy itself.
There was. The Centix Investor Confidence Index for July actually improved quite a bit, jumped from zero point 0.2 up to 4.5. That's its highest level in over 3 years.
Suggesting the recovery there is broadening out.
Looks like it. But despite that improved sentiment, markets don't expect the ECB to move soon. There's a greater than 90% probability priced in for no change at their next meeting on July 23rd.
Even after all the rate cuts they've already done.
Right. They've cut 200 basis points since mid-last year. Seems like they're in a holding pattern for now.
And quickly, the UK gilt yield.
Britain's 10-year gilt yield finished 3 basis points higher at 4.593%. That follows that big sell-off they had last Wednesday after the government reversed plans for welfare spending cuts.
Just shows how sensitive bond markets are to fiscal policy decisions.
It really does. And, thinking about all this, the shifting rate expectations, the bond yield moves, the ongoing trade stuff, it creates a really complex picture for investors, doesn't it?
It absolutely does. It's not just about one single factor anymore.
No, you have to understand how all these pieces interact. The ripple effects are key.
Which brings us back neatly to that main theme. Trade uncertainty. Let's just recap the specifics of those tariffs announced Monday. South Korea and Japan hit with 25%.
Correct. Malaysia also got 25%. And then some others, like Thailand, faced even higher rates, 36%.
Seems quite targeted.
It does. But what's really interesting is that August 1st deadline extension. It wasn't just a delay. President Trump signed an executive order.
Signaling openness to negotiate.
Exactly. The order explicitly said he's willing to negotiate the tariff rates if countries come back with alternative offers. And the White House even mentioned they were close to finalizing several trade deals.
So, less of a hard line, more of a negotiating tactic, using the tariffs as leverage.
It certainly looks that way. Almost like a high-stakes poker game, with the tariffs as bargaining chips.
And that extension buys time, politically speaking. Especially for Japan, right, with their elections coming up.
Yeah, Japan has upper house elections on July 20th. Their government is particularly sensitive about agricultural tariffs, so having more time to negotiate is helpful. And South Korea also saw it as a grace period for their ongoing talks.
So the door isn't closed on deals.
Not at all. Dialogue is clearly still happening.
And crucially, some big players were not hit with new tariffs this time around. India and the EU.
That's right. Reuters reported the EU might be close to a deal. And President Trump himself said a deal with India was also imminent.
So it's a very selective approach, country by country.
It seems so. Not a blanket policy, more like individual negotiations, individual strategies for each trading partner.
So tying this all together then, for you, the listener, we see these fluid deadlines, these ongoing negotiations, these sudden tariff announcements followed by extensions. It leads back to that core question. Is this constant state of flux, this strategic use of tariffs, is this just the new normal for how global trade works now?
It certainly feels like it might be heading that way.
If you had to leave our listeners with one final thought on all this, what would it be?
Well, maybe think about how businesses and even individuals need to adapt their planning. How do you assess risk when trade policy can shift so quickly, so unpredictably?
Building resilience to policy shocks.
Exactly. That resilience might become just as important as analyzing market fundamentals. What does this mean for investment, for supply chains, for overall stability? It's definitely something worth mulling over as we navigate this environment.
That's a really powerful thought to end on. Thank you for walking us through all that today. It's clear things remain incredibly complex and interconnected.
Indeed. Hopefully we've helped shed some light on it.
We certainly encourage you to keep exploring these topics. Understanding these shifts is, well, more critical than ever.
Absolutely.
Thank you for your attention. You can subscribe our podcast if you like it.
See you next time.